The number one question I get asked as an accountant is, should I buy my car through my business? And usually by the time someone's asking me, they've already been told it's a good idea. A mate, a mortgage broker, someone at the pub has said,
just put it through the business. You get a tax deduction.
So they're not really asking me whether they should. They're asking me to confirm what they've already decided. The problem is, when I actually sat down with a client and ran the numbers on this, what came back really surprised them. Because in year one, buying through the company was the better option. But by year three, they'd broken even. And every year after that, they would have been better off just buying the car in their own name. So I want to walk you through what's actually going on here, because there's a cost that most people will never hear about, and it completely changes the maths. The cost is called fringe benefits tax, or FBT. So when a business owner owns a car and they use it personally, even for some of the time, the ATO treats that as the business giving you a personal benefit. And there's a separate tax on that benefit, and it's calculated on the private portion. For example, if your business use is 80%, the ATO is looking at the other 20% and charging you for it. The rate they charge you at is 47%, which is the highest marginal tax rate, and it's actually calculated on the grossed up value of the benefit, meaning there's some complex calculations that go into it, not just the dollar amount you've spent itself. So the actual hit actually ends up being way higher than what most people expect, and it gets charged every single year you own the car, not just when you buy it. Most people have never heard of fringe benefits tax until they're already paying it. And the reason the maths on buying through the business doesn't work for most people is because this tax is running in the background the entire time, wiping out the benefit of the deductions you're claiming on the other side. So here's how it usually starts. Someone's talking to a mate, or they're at a barbecue and they hear,
yeah, my accountant's putting the car through the business. And that's it.
That's the full extent of the advice. They don't hear the details, they don't hear the conditions, they just hear tax deduction and assume the car is basically subsidized by the government. And honestly, I get it. If you've never been told otherwise, that's a perfectly reasonable thing to believe. You hear business expense, tax deduction, and you think, that's got to be a good thing, right? So when a client comes to me and says,
my mate's accountant puts their car through the business, why aren't we doing that?
I always say the same thing. There's only really 4 explanations for what's happening with your mate. Option 1, their accountant is doing everything properly, dealing with all of the costs behind the scenes, and your mate just doesn't realize it's not as beneficial as they think it is. Option 2, their accountant knows what they should be doing and isn't doing it, which is a problem for your mate, not a strategy for you. And option 3, their accountant genuinely doesn't know what the right thing is, which is also a problem for your mate. Or option 4, they're driving an electric vehicle or a legitimate commercial vehicle, and they're in one of the few situations where the rules are actually different. Now, I just want to clarify, I'm not out here throwing shade. Most of the time it's option 1, not 2 and 3. The accountant is doing the right thing, but the client actually has no idea what it's actually costing them because they've never seen the full picture. So let me show you what the full picture looks like. I had a client come to me wanting to buy a car. The car was a RAV4, about 60 grand drive away, with about 80% business use, which is actually on the higher end for a lot of business owners, depending on your industry, of course. So we ran it both ways. What does the car look like buying it through the company versus buying it in their own name? And we factored in everything from depreciation and running costs to finance costs. This is what it looked like. In year 1, buying through the company actually came out $6,800 ahead. That's because you get the GST credit on the purchase up front, which is about $5 grand on a $60,000 car, plus the running cost credits and the tax deduction on depreciation. Even after paying the fringe benefits tax, the company still wins in year 1. But in year 2, the picture changes. The big GST credit is gone and the FBT is still running in the background. So by year 2, the individual is nearly $2,900 better off for that year alone. In year 3, another $2,300 better off for that year. So when we look at it over 3 years, buying the car personally saved this client roughly $3,600. And that gap keeps widening every year they hold the car. When we looked at this over a 5-year period of owning the car, the total cost of buying through the business versus just buying it personally was roughly $8,000 more. And the reason for this is the fringe benefits tax I mentioned earlier. The deductions you're claiming on the business side are real, but the FBT is also running in the background the entire time based on your personal use. At 80% personal use, that means 20% of the time the ATO considers the company to be giving you a personal benefit. And in our example, the FBT worked out to be roughly $4,700 in year 1. Now, that does drop each year because the car's value goes down, but it never goes away. And there's another thing worth knowing. If you're looking at a more expensive car, the ATO has what's called a car cost limit, which for this financial year is 69K. That is the maximum amount you can use to calculate your depreciation deduction. So for example, if you go out and buy a $200,000 car, you're only claiming depreciation as if it only costs 69K. But the thing is this, fringe benefits tax doesn't have the same cap. FBT is calculated on the actual cost of the car. So you're getting capped on the deduction side, but paying the full amount on the FBT side. The more expensive the car, the worse that gap gets. Now, there are exceptions to this because not every car and not every situation works the same way. The first one is electric vehicles. If you buy an EV through your business, it's exempt from fringe benefits tax as long as it meets certain requirements. So you can get the upside of claiming through the company without the downside that wipes out the benefit for everyone else. That's almost genuinely like having your cake and eating it too. And it's one of the few situations where I'd say, yeah, seriously consider it. The second exception is if the car is a legitimate company car. And I mean legitimately, it's parked at the business, the keys stay at the business, nobody takes it home for personal use. If you can prove there is zero private use, then the fringe benefits tax may not actually apply at all. But honestly, for most business owners I work with, that's not the reality of how they use the car. The third one is commercial vehicles. And this is where tradies usually come in. If you've got a panel van or a vehicle that's genuinely built to carry equipment and materials, it may not fall under the same rules as passenger vehicles. So the FBT issue I just walked through might not actually apply to you. But here's where people get caught out. A lot of people here buy a ute and think that automatically puts them in the clear. It doesn't. The ATO has a specific way of working out whether your vehicle is primarily used to carry people or carry things. They look at things like curb weight, they look at the carrying capacity, and there's a formula that they run on it. So just because it's a ute doesn't actually mean you're exempt, and that one catches more people out than you think. So at this point, you might be thinking, okay, what if my business use is genuinely high, like 80% or more? Surely that changes things. And yeah, you're right, it kind of does. The higher your business use, the less fringe benefits tax you're paying. So the longer the benefit of buying through the company lasts before it actually crosses over. But even then, I'd push back on that. Because if you've got 80% business use and you buy the car in your own name, you're still claiming 80% of your depreciation, your interest, your running costs. You're getting most of the benefit anyway. The main thing you miss out on is a GST credit, which on a 65K car is about $6,000. So the question becomes this. Is $6,000 worth taking on the FBT complexity and the additional compliance, and eventually it costs you more to have it in the business? Because the logbook requirements are the same either way, whether the car is in the business name or in your own name. The ATO can still challenge your business use percentage. For most people, I don't think it is. So if you're about to head to a dealership and you've got a business that runs out of a company or a trust structure, the one thing I want you to do before you sign anything is ask your accountant to run the numbers. Not just for year one, but over the life of the car, because the year one picture and the year 5 picture can look totally different, like in our example earlier. On that note, if you found this video helpful, don't forget to like and subscribe, and we'll catch you in the next video. And if you want to understand how this fits into your broader tax position, I'll leave a link below where you can book a call with our team. Peace.